Welcome to the Daily Update Podcast, where I'll go over the action in the market for Thursday, October 2nd, and we'll see how things look for Friday, October 3rd. Going over what happened in Thursday's session, the major indexes, the S&P 500, Dow, NASDAQ, and NASDAQ 100, all touched new all-time highs yet again. But the session closed with minimal gains, with the S&P being up just 0.06%. This lackluster close, coupled with below-average trading volume, signals a lack of conviction among investors. The day began with a higher open near the R1 resistance level at 67.58, which set the intraday high. Prices quickly pulled back, dipping below the psychologically and technically significant level at 6,700. Support was found at the daily pivot at 66.95, allowing the S&P to recover slightly and close just above 6,700, though below the 67.25 level. This tepid performance reflects what some analysts are calling uncomfortably bullish sentiment. While the S&P remains positive across the short, intermediate, and long-term time frames, there's a palpable hesitation among investors, many of whom question the sustainability of this rally. Interestingly, this skepticism may be fueling the market's upward drift, as contrarian dynamics often drive gains when trust is low. A key factor influencing the markets right now is the ongoing government shutdown, which has delayed critical economic reports, including the highly anticipated employment situation report originally scheduled for Friday, October 3rd. Without this data, uncertainty is creeping in, and historical precedents, such as 1995, suggest the markets may remain lethargic until fresh data emerges. Delayed reports risk becoming outdated, potentially reducing their impact when finally released. Senate Majority Leader Thune indicated that a resolution to the shutdown is unlikely over the weekend, adding to the uncertainty. Despite these headwinds, several factors are supporting the market's resilience. Interest rates are trending lower, creating a more favorable environment for stocks. Corporate earnings remain robust, and the market is not pricing in a recession, which would typically erode stock valuations. Household liquidity is also strong, with cash reserves high relative to debt across all age groups, providing a buffer against economic shocks. Additionally, the construction sector is showing strength, with a ratio of residential construction payrolls to housing permits reaching a 10-year high. Turning to sector performance, semiconductors stood out on Thursday, with the SMH Semiconductor ETF gaining 1.36% and setting a new all-time high. This underscores the ongoing strength in tech and growth-oriented sectors. However, not all growth stocks fared as well. Tesla, for instance, dropped over 5% after its earnings report, as investors reacted to news of expiring tax credits potentially dampening future demand. Elsewhere, materials led sector gains while energy and communication underperformed, with energy pulling back after a recent strength. From a technical perspective, the market is showing mixed signals. Short-term momentum indicators such as the Williams %R, CCI, and stochastics are strong but possibly rolling over. The S&P 500 is currently 11.41% above its 200-day simple moving average, a level that raises concerns about overextension. Gamma exposure charts highlight potential resistance at 67.25 and 67.50, which could cap any near-term upside. Meanwhile, the VIX remains low, but rising correlations between the VIX and S&P hint at growing fear that could precede a pullback. Looking ahead to Friday, October 3rd, the outlook remains cautiously optimistic. Historical seasonality data favors a positive session, with October 3rd showing positive results going back to 1980, and for the month showing a 59% win rate going back to 1950. The S&P is well above support levels, including the 6,700 mark, the 64-68 weekly pivot, and the 20-period moving averages. However, the absence of economic reports may lead to subdued trading volume and limited conviction. Should the market push higher, watch the resistance at 67.25 and even higher at 67.50 as indicated by the gamma exposure chart. Positive seasonality does extend into early October, particularly in post-election years, and the broader market trends dating back to 2009 remain intact. Growth to value ratios are holding up but showing more short-term weakness, with tech continuing to outperform staples, a bullish signal. However, the mixed technical picture and overvaluation concerns suggest investors should remain vigilant for signs of a pullback, especially if positive conviction fails to materialize. The S&P 500 strength is underpinned by solid earnings expectations and a lack of recession fears, helped by significant capital expenditure from mega-cap firms such as Alphabet, Amazon, and Microsoft, particularly in AI. While some may debate that we're in a bubble, historical comparisons to past manias, such as the dot-com bubble or tulip mania, highlight the importance of earnings in sustaining valuations. For now, the S&P appears to be shrugging off geopolitical tensions and the government shutdown, focusing on these fundamental drivers. In conclusion, Thursday's market showed resilience but lacked conviction, with new highs tempered by low volume and uncertainty from the government shutdown. For Friday, expect a potentially positive session, but stay mindful of resistance levels and weakening short-term momentum. Thank you very much, and I will talk to you in the next podcast.